October was a more volatile month for markets, with equities and bonds moving lower. The up-and-coming US election, the potential implications of a policy shift on inflation and interest rates caused global uncertainty. Here in the UK, the first Labour budget in 15 years caused market paralysis as investors tried to forecast what Chancellor Rachel Reeves would do. All eyes remain on the macroeconomics and the direction of interest rates and inflation. The US has been the bellwether for financial markets and investors were firmly fixed on its inflation data. The September CPI report indicated that inflation eased by less than expected. However, core inflation remained elevated at 3.3%, driven by rising costs in medical care, auto insurance and airline fares. Following the Fed's 50 basis point interest rate cut in September, the sticky core inflation reading highlighted the challenge facing US policymakers if they are to achieve their dual mandate of maintaining a solid labour market alongside price stability. Rate cuts are still expected in November and potentially December, but a stronger labour market and resilient inflation has reduced the likelihood of a 50 basis point cut at either of these meetings. It's fair to say cooling in rate cut expectations alongside election uncertainty has unnerved equity and bond investors. In the UK, the labour market remains tight, with unemployment rate falling to 4% and pay growth remaining at 4.9%. Despite this, September's headline inflation declined to 1.7%, with core inflation at 3.2%. At the end of October, we also had the UK budget. The policy announcements put pressure on the UK gilt market due to stronger than expected levels of spending now planned for 2025. Gilts were an underperformer on the month, ending down 2.8%. Turning to equity markets, developed market equities posted a negative return of 2%. Japanese stocks were the top performer despite concerns that the need for a tighter policy and a stronger yen could impact the export-orientated companies, as well as political uncertainty created by recent election results. Third quarter earnings season began in the US with strong results from the banking sector. Guidance was more mixed for tech companies, particularly on semiconductor demand, which added to market volatility. Generally, positive earnings surprises were among the lowest of recent quarters, highlighting some decline in earnings momentum, which in turn added to the downward pressures in equity prices. Emerging markets declined by 4.3%, pressured by a stronger US dollar, profit-taking in India and volatility in Chinese equity markets due to the uncertainty around the efficiency of the support measures announced in September. Growth stocks outperformed their value counterparts but fell 1.8% in the month. Small caps retraced by 2.7% as slowing economic momentum continued to weigh on sentiment. The global bond index fell by 3.7%, highlighting uncertainty over the trajectory of global interest rates. This trend also reflects the impact of a strong US dollar and uncertainty around the US election and subsequent policies. However, investors should remember that historically, the start of a rate cutting cycle has often resulted in significant returns for government bond markets in subsequent years. Here at Progeny, recession risks remain a key concern. However, our base case of a soft landing scenario with falling inflation and interest rates is still in place. We continue to believe in the broadening of returns across various asset classes and that returns could shift from the concentration in big tech to other sectors and stocks. Fixed income markets are likely to experience further volatility until the path for rate cuts becomes clearer, though historically falling rates have boosted government bond returns. The US presidential election, potential policy changes are a source of uncertainty and have already contributed to a move higher in bond yields. In summary, there continues to be uncertainty around geopolitics and macroeconomics, but a balanced and diversified portfolio combined in equities and fixed income can help navigate such uncertainty.